Hello, and welcome to this special CBTV interview with John Evans, president of Evans Advisory Services in Erie, Pennsylvania. John is a certified financial planner who, since 1993, has specialized in working with retirees and pre-retirees. In addition, he is a certified public accountant and a chartered retirement planning counselor. Once again, John, welcome back to Checks and Balances TV.
Thanks, Matt, for having me. Appreciate it.
Good to have you here. I want to start off by talking about a very well-known rule that in the financial advisory and financial services community we know, but many consumers are not aware of, and that is the rule of 100, the investment rule of 100. So tell our viewers, what does that rule mean, and how do you help your clients with that rule?
Well, the rule was really intended to get people to think about the balance between risk and safe investments as they get older. So the way the rule works is you take your age, subtract it from 100, and that is the starting point for discussion regarding how much of your assets you'd have exposed to risk. Obviously, the remainder would be in safe money alternatives that weren't subject to risk. It is a rule of thumb, which means that you take a look at each person's individual circumstances and don't apply the results of that calculation as a hard and fast thing, but it's a good way to start a conversation with people about managing their investments differently than maybe they have traditionally managed them, especially because they may be at a new point in their lives now, and they need to think of their investments in terms of where they are in life now as opposed to where they were 10 or 20 years before.
So as an example, if someone was 65 years of age and retired, you take 100 minus 65 leaves 35. So
Right.
that basically means that 35% could still be in the stock market, stocks, bonds, mutual funds. The other 65% though should be in safe accounts that aren't subject to or tied to the stock market. Is that correct?
That's correct. That's the general idea. And again, that idea is not very popular with the Wall Street folks, obviously. They'd like to see 100% of it exposed to risk, maybe a different mix between stocks and bonds, for example. But I think it's more important that we have a fair amount of our money when we're in retirement in things that can't go down, where the principal's protected. And in fact, there are many alternatives out there that get a pretty decent return. So it's not as if we have to sacrifice return for safety.
Yeah. So in essence then, as people get older then, John, they should have less and less of their money at risk in the stock market and more of their money in safe, guaranteed type of accounts. Is that correct?
Absolutely correct. That's the lesson I preach loud and long.
And the number one reason for that is, in your estimation, what? As they get older and older, they have a shorter time horizon, or they're going to use that money, or what's the?
Well, it's really a combination of those factors. The stock market, at least historically, has done well over time, but it is clearly for the long-term investor. Well, someone who's 65 or 70 is not as long a term investor as someone who's 45. Second of all, they're at a point in their lives where, in many cases, they need income from their investments to support their lifestyle. The stock market is not particularly well suited to produce income. There are other alternatives that are better suited for that. And if the market's going down and you're taking income from your account, you're really exacerbating the decline in the account. And then there's a whole portion of the account that's no longer there when the market returns. So that's the way people run out of money, is they're taking money out of a falling asset. By restructuring our assets, we give ourselves various options where in a falling period of the market, we can take money from someplace else and let the market rise again and recover our funds through that. So it gives us a lot more flexibility.
It's a very good point. If somebody is in retirement and taking money out of their nest egg, and that nest egg is still in the market, and the market does a big correction of 30, 40, 50%, that money's disappearing quickly. That's like a rock just falling to the ground.
Sure, and every dollar that you take out of a market account is a dollar that can't earn any return any longer. So it's not just the dollar you've taken out, it's all the earnings on the dollar would have generated in the future that you've also removed.
Very, very good point. Very good point. Well, let's talk about now the risk portion and then the safety portion. So if someone's 65 and they say, I still want 35%, John, in the market, where are some of the best places I can put my money as far as the risk side of my portfolio?
Well, traditionally people have looked at stock mutual funds as a favorite investment because there was some diversification built into stock mutual funds. While stock mutual funds are still popular, I would say that a newer type of investment that's become very popular are exchange-traded funds. Exchange-traded funds are a mutual fund that trades like a stock, so it has a much higher degree of liquidity than the typical stock mutual fund does. And the exchange-traded funds are more focused, so we can buy an exchange-traded fund, for example, focused on gold. Everybody's been interested recently in owning gold, but physical gold's kind of a problem to own, but you can buy the gold, any one of several gold ETFs, and get the same benefits of owning gold, but with something that's immediately liquid if you needed to sell it, or if the market was declining and you wanted to liquidate your investment in order to protect your gains. So exchange-traded funds have been very, very popular as a risk investment. Real estate investment trusts have gone up and down. At the moment, they seem to be making a little bit of a comeback as the commercial real estate market seems to be improving a little bit. So that's another place where I think people are looking at things, particularly on the publicly traded side of real estate investment trusts. The non-publicly traded side still has some liquidity issues, but non-publicly traded REITs are another opportunity.
So 3 ideas on the risk portion: stock mutual funds, ETFs, and perhaps some REITs, the right type of REITs it sounds like.
You bet.
ETFs, though, that's kind of the new kid on the block compared to the other two. Do most consumers understand what an ETF is?
Actually, very few do. As a matter of fact, when I see people's statements routinely, new people that come to our practice, I very rarely see exchange-traded funds in their portfolios. I don't think most financial advisors use them with their retail clients, other than the very sophisticated clients. And that's too bad, because exchange-traded funds have 2 distinct advantages over stock mutual funds. One is that they have much lower expense ratios, generally speaking. So it means you're spending less money to own that particular investment. And number 2, they have much lower capital gains distribution. So if the money is not qualified money, IRA money, 401k, but rather non-qualified money, then lower capital gains distributions can be a significant advantage to the investor.
Lower fees, lower taxes? Sounds like a no-brainer to me.
I think so too.
So more and more consumers, in essence, what you're saying, John, need to know about how ETFs can work for them.
Absolutely, absolutely.
Okay.
And I manage a lot of portfolios that have significant ETF exposure.
Wonderful. Let's flip the coin now and talk about what are some good ideas as far as clients to consider on the safe portion of their portfolio, with CDs, a 1-year CD averaging 0.36% and a 5-year CD at 0.28% right now. What are some other safe money ideas that would be attractive for people that want some of that money safe and sound?
Well, it's interesting that you asked that question, because I meet so many people that believe there are only 2 investments you can make: a CD or the stock market. And so when I talk about a variety of safe money options, they're really blown away by that, because they never considered anything else. But there are several that I've been using with clients over the last years that I think are very effective. The first are fixed annuity products, fixed index annuities, traditional fixed annuities. These are products where the principal can't be lost, and every time interest is credited to the contract, it becomes part of the guarantee. So this is a product that only goes down when the person takes money out of it. Other than that, the only direction it goes is up. Second of all, we use a lot of bond ladders. These are ladders of individual bonds, not bond funds. Well, bond funds are subject to variations in the marketplace, but when we buy individual bonds and hold them to maturity, then we've got something that is only subject to the possibility of the issuing corporation defaulting on the debt.
Right.
And with corporate America holding over $2 trillion in cash on balance sheets today, the chances of any major corporation defaulting on their debt is very, very low. And the corporate bond ladders have produced a pretty solid return in the 4 to 5.5% range these days, which is about where fixed annuities and indexed annuities are, in about the same range there. Yeah. A third idea, which is relatively new on the retail side of life, are indexed certificates of deposit. These are bank certificates of deposit that are principal protected, meaning the bank is guaranteed the principal, and also FDIC insured. So if the bank failed in its commitment, the FDIC has to step up. They're called index CDs because the interest they pay is tied to one of a variety of indices. And these only became available about a year ago. Prior to that, they were used by hedge funds extensively to hedge their investments, but they were only available in $1 million denominations, which is a little out of bounds for most folks.
Middle America.
Yeah, but now they're available from those same banks that have 10 or 12 years experience with them. They're available in $5,000 denominations. So all at once, we've got the same kind of vehicle the hedge funds use to hedge their risks. Now we can do with individual retail investors. So those are three things that I've done extensively. They all have pretty solid returns, much better than the CD money market returns of today. And so it's been quite successful for a lot of my clients.
And plus CDs, of course, even if you don't want the interest, you still have to pay taxes, don't you? So it's like adding insult to injury.
Well, of those three alternatives, the one that has the preferred tax position are, of course, the annuities.
Right.
Annuities have, since the beginning of the tax code, had a preferred status, so you don't pay tax on the interest until you withdraw the funds.
Some real benefits there. So on the safe money side, it's not just CDs at the local bank. You've got, as you said, fixed annuities, and some fixed annuities pay a guaranteed interest rate for all years of the contract. Or you have, you said, the fixed indexed annuities where you have guarantees, but if the market goes up, they can capture part of that gain. And I understand that gain is locked in. It becomes, as you said, a part of the principal.
Right.
So that's good to know. If the market goes back down 20%, they don't give anything back. Is that correct?
That's correct.
So that's a very good account, I'd imagine. And then some individual bonds, you said as long as they hold them until maturity, there's no loss of principal of what they put into the bond.
No. In the corporate bond scenario, the price of the bond is really becomes a somewhat immaterial part of the value calculation because the bonds are typically bought somewhere in the 98 to 103 range for something that's going to mature at 100. So that's not the real economic benefit. The real economic benefit is the interest rate on the bonds. And these days, we see coupon rates on corporate bonds as high as 6.5% and 7%. Wow. So there's some significant opportunities there.
Absolutely. And the last one was the index CD. That's the new kid in the block. That came out about a year ago. Is that right?
Right. It's to the best of my knowledge, I think I'm the only one in northwestern Pennsylvania that's talking to anybody about that particular issue, because I haven't had anybody come to me in the last year and say, well, you know, somebody else told me about this. Just haven't heard it.
Another very good reason why people from Erie, Pennsylvania should be working with Evans Advisory Services.
That's right. That's right.
Well, John, some great information about the investment rule of 100 and some good ideas and vehicles for the safe money side as well as the risky side or market side. And as always, very informative. Glad you're here, and we'll look forward to the next time you come back.
Thank you. Thanks for having me.
You know it. For more information about John Evans and his financial services practice, Evans Advisory Services, contact him at 814-464-0224 or visit him on the web at www.evansadvisoryservices.net.